All right. Hello, everyone. Happy Monday. Welcome to your weekly market check-in here with myself, Greta Wall. I'm your host, and I'm joined by Derrick Oldensmith, the head trader at T3 Trading Group and leader of T3 Live's Pro Desk virtual trading floor. Derrick, happy Monday. How's your day going so far? Oh, actually, wait. Before we get into any market-related discussions, just for disclosure purposes, here are Derrick's current positions as of our recording here today. So there we go. All right, Derrick, how is your Monday in the market going so far?
Yeah, not bad. At the end of last week, we really started looking for a mean reversion trade. This market's been very unique, and boy, it's only February 9th, but it feels like we've already traded a full calendar year so far this year. It's just been so crazy. There's been so much going on, but this market has been marked by a tremendous amount of dispersion or rotation. They're synonyms for the same thing, where again, the S&P hasn't really done too much. But if you look at like the NASDAQ traded very, very poorly last week. Whereas if you look at the RSP, the equal weighted S&P, that's been breaking out to all-time highs. The Dow's been breaking out to all-time highs. So this has been a market that's been very, very much defined by the market itself, honestly not doing too much, but there being huge winners and huge losers underneath the surface of things. And the losers have been kind of the Mag 7 tech stocks, but even more so than that, software companies. And the winners have been like consumer staples through the roof. I mean, the move in consumer staples so far, starting on the last day of January through February, has been nothing short of remarkable. So really on Thursday last week, we started looking for a bit of a mean reversion trade where software, which is in a deep bear market at this point, gets a little bit of a bounce, whereas consumer staples and some of the stuff that's been really strong that's actually extended to the upside pulls back a little bit. So just a little bit of mean reversion. And Thursday during the day was a little bit too early. The capitulation actually happened Thursday after the close in like software and crypto. Thursday after the close, after Amazon reported, things were just crumbling, but crumbling to a degree of downside extension in the NASDAQ that was becoming completely unsustainable. It makes for a difficult trade because you really had to come in and buy like Thursday night after the market closed for your best return and keep it overnight into Friday. That's a tricky trade, but the trade has worked, and we got some of that mean reversion beginning on Friday with the NASDAQ bouncing back, software bouncing back a little bit, and a continuation of that today with that stuff bouncing even further. And finally, like consumer staples, this XLP rolling down a little bit. So not an easy trade, a very unique environment, but it's working great.
Like you said, it feels like so much has happened already this year. It's only February 9th, like you said, but there's been a lot in this market. You and I haven't talked. The last time we talked was pre-Microsoft, Meta, Apple, that week of earnings. And then last week was Google, Amazon. So we kind of rounded out the Mag 7s. We got them all except for NVIDIA, because NVIDIA has to report late. But we got all the Mag 7s so far, except for NVIDIA. What do you think about those reports and the reaction to them? And who would you declare like the big winner of the Mag 7 names?
Sure. So, Greta, you and I have been discussing this theme that we have seen on the horizon coming for these Mag 7 companies for several quarters now. We've been talking about like, wow, this CapEx spend that's coming from these companies, it's crazy. Is there going to be a certain point where the market wakes up and says, hey, we need a return on our money. We need a return on our spend. We don't want you just spending nonstop if the revenue is not showing up for it. And I feel like we started to see a little bit 1 quarter ago with Meta and Oracle kind of being the poster children of, hey, there's a lot of spending going on here and we're not seeing revenue. And it seems like that just expanded even further this quarter, where you look at Meta. I can pull up some charts if you want here. Let me get the screen share going on for you. Cool. I think you should have them.
Yep.
Cool. So if you look at like Meta's report was pretty good because they had like a really good beat on their operating income. Yet the market was like, you know what, that CapEx spend, we're just going to sell down the gap up. So Meta got sold all the way down, fully filled their gap up from the earnings report. Now they're bouncing back a little bit, but this is a pretty kind of sloppy and broken looking chart. You had Microsoft. Also, I didn't think that the earnings report was that bad at Microsoft, but you just had a bad combination of Microsoft being a software company, and software stocks have been getting absolutely pummeled. And once again, this heavy AI CapEx spend. And it seems like Microsoft also moves a little bit just with how OpenAI is perceived. And I think that OpenAI losing some share to Google also had something to do with this kind of gap down and continuation to the downside in terms of selling that we saw in Microsoft. So both of those, as far as I'm concerned, like great earnings reports, but the market's like, you guys are spending too much money and we need to see more of a return from it. You're getting a little bit of an oversold bounce coming in Microsoft finally at this point. Amazon, the most recent one, same thing. Their CapEx expectations were their CapEx guidance was way ahead of expectations, and the rest of the earnings report was fine. And they have just destroyed this company. Huge after it had already been selling down, just a huge gap down and continuation. Google is interesting because Google, as far as I'm concerned, is the winner in the space right now. They are constantly gobbling up more and more share of AI. So this is the one company where it's like, okay, yeah, we don't love that the CapEx is more than expectations, but at least there's a plan here. At least there's revenue coming from it. We can see a light at the end of the tunnel for Google. So Google, they gapped it down on that earnings report, but then they kind of brought it all the way back up, and it's hanging in better than any of those others. So insofar as like those three really big CapEx spenders, or I guess four, Meta, Microsoft, Amazon, and Google is seeming to be by far the winner in the space. And you can see it in the price action compared to the other three. What that leaves in the other Mag 7 space is one, Apple. Well, Apple's not spending on AI, so the market doesn't care. And this actually has become a defensive play. I was just discussing with you earlier about this incredible move when you can look at IGV, which is a software ETF. It's got Oracle, Microsoft, Palantir, some of the biggest holdings, but I'm sure it's also got like Salesforce and a lot of those other companies that have been trading really poorly. Software stocks, a software ETF, I mean, this is a bad bear market that they're in. And this was just making highs back in October. This ETF was at $118 in October. It broke 80 on Thursday, and this was even lower than that after hours on Thursday. So this thing is just in a massive bear market, which is incredible considering the fact that the market is at all-time highs. Whereas again, consumer staples, this move is historic. This is one of the biggest, fastest moves in what is typically a very boring sector to the upside in a long time. But what are consumer staples? Consumer staples are a safety play. What else is a safety play at this point in time? Apple. In some ways, Apple is almost like a consumer staple company at this point with the way that it trades. Apple not being involved in the heavy capital expenditures that these other companies are doing. When the market decides like, whoa, we're sick of this CapEx, Apple actually becomes a defensive play. And you can see, whereas the NASDAQ has had a very rough start to February, Apple has been straight up. So Apple is a winner of this for the moment because they're not a spender. Google is a winner because they are the winner. And Meta has a great underlying business helping hold the company up, but they're definitely not doing it on that front. Microsoft also, same thing. They're not the winner. Amazon, not the winner. And then that leaves in Mag 7 land just two other companies, Tesla and NVIDIA. Well, NVIDIA likes the CapEx spend because they're the ones that are benefiting from it, right? When Amazon says, hey, we're going to spend way more money than expected, NVIDIA goes, okay, that's more money for us. So you could see actually how well NVIDIA reacted to Amazon earnings report, whereas Amazon got absolutely destroyed because they're just going to be spending even more money. And then the final other one is Tesla, but Tesla's just in a complete universe of its own. Just a complete universe of its own. It's not trading like any of the other ones. It's just like SpaceX and XAI merger and IPO that's coming, and how does that impact Tesla and Elon Musk, and are they even a car company? It's just a completely different story. So that's kind of where we're at with our Mag 7 companies now that they've all reported except for NVIDIA.
When it comes to the earnings season overall, I'm not just looking at the Mag 7 companies, but we're a few weeks in now, and of course still a lot of big companies to report. But when you look at this earnings season so far, what's your take on how the market is reacting to the reports?
It seems like if you're missing, you're getting punished really, really badly. But it's still one of those typical earnings seasons where, 75, 80% of companies, whatever it is, beats, which, by the way, that sounds like a really high number, but it's relatively normal. Most of these companies like to guide conservatively so that they can set themselves up for consistent wins. But it's definitely been a report where if you are one of those companies and you're missing, like, look out below. They are absolutely punishing you for it.
All right, in addition to some earnings this week, it is actually a very busy economic data week because we had a really short little government shutdown last week that delayed some data and pushed it to this week. So we're getting a lot of jobs data this week, tons of Fed speakers as well. The official Fed January jobs report will be Wednesday morning before the open. And then still the CPI is this week. So the CPI was supposed to be Wednesday, got pushed to Friday because the jobs report is Wednesday. So whatever. So we get both jobs and inflation this week, which is the double whammy for the market and what the Fed cares about. So when it comes to these reports this week, do you think they are going to be really important, market moving, or non-events? The Fed did not cut as expected, and we're still sitting here data dependent. So I feel like this data really matters. It's the first readout since that Fed decision before the next meeting. So what do you think?
Sure. So, I can never know what the numbers are going to be, and I can never fully know what the numbers are, what the reaction to those numbers will be, even if it will happen. What I can tell you right now is I think that as we are here in February, it's February 9th. February is historically the second weakest month of the calendar year, and positioning is very full right now. What I think that means is that the risk is to the downside. So while I, can't tell you what the numbers are going to be, and maybe they come out phenomenally well and the market just breaks up to all-time highs, that's something that could certainly happen. I think that there is a higher risk of a outsized move lower here in February, especially as we kind of get through this week. The peak of seasonal bullishness is February 13th, actually, and the second half of February typically is when we're significantly weaker. I'm very cautious right now on any new big picture longs in this environment, because the flip side is if we can get a catalyst to the downside, which is always an if, but when you've got a lot of events coming this week, there is the potential that one of those could be the catalyst of an if-then statement, where if we were to break lower, then we could sell down really hard. So I'm watching two things here with the market in conjunction with all of our economic data and everything that's supposed to happen this week. And those are basically lows for the year. So once again, I'll just pull my chart up really quick. Lows for the year were just tested again on Thursday with the market sell-off. You can see that here with the SPYs. That's also basically the same low as January. If these lows really break this like equal low, watch out below, because I think that you're going to trigger a lot of systematic selling beneath that. And then the other big thing that I'm watching in conjunction with that level in the market is just correlation. I was discussing with you just a moment ago, and this is, I think, a big clue for how the market is going to trade. IGV software versus consumer staples is probably the most extreme example right now of one sector being extremely weak and one sector being extremely strong. Watch out if they all start trading together. If instead of, like right now, in order for the SPY to be in this range and going sideways, but for software to be down as much as it is, it inherently means that something else has to be up, right? Because it's like a balance, it's an index. Watch out if you begin to see all of those sectors begin to sell at the same time. If they're all selling at the same time and correlations are increasing and we are approaching those lows, the January, February lows for the S&P, while you're seeing the ridiculously strong RSP sell down and you're seeing the IWM, which looks great, sell down, and you're seeing the Dow sell back down in conjunction with the Q staying weak, that's your signal to, in my opinion, run for the exits, get your shorts lined up, never chase, but just be prepared to short if that were to happen. So again, that's an if-then statement. And that's how I like to think about markets. I think it's just kind of a good general lesson for anybody that you have listening today is we want to think about the different scenarios. Well, if this happens, it can lead to this, or if this happens. I don't know that that's going to happen. I'm just saying it's something that you really want to be mentally prepared for if it were to happen. Because the flip side of that, again, is there are some things that you could point to with this market right now that are very bullish. These buys, as we're talking, are working their way right back to all-time highs. The RSP, the average stock in the market, the 493 minus the 7, well, it's probably a little bit less than that, are doing phenomenally well right now, and you can see that in the RSP.
With this software meltdown, I mean, software is left for dead, and everyone says AI is just going to kill these companies. And then last week, we also have the whole, oh my gosh, is AI just a bubble? And should we get out of this trade thing happening at the same time? AI is going to kill all these companies, but then the trade is just a bubble over here. What do you think about the thought on the software companies? Are they dead, or can they recover?
Sure. So I was having an interesting conversation late last week with the traders and the team when we were looking at software, and they're selling down any and everything that's a software company. And I'm having a conversation with my traders that I typically only have in bear markets. When you're in a bear market, here's another great exercise for listeners. Market goes down 20+%. It's going to happen someday in the future. Your guess is as good as mine on when that will happen. But you find that the market's down 20, 30, maybe even 40%, something really bad happens. They sell everything in down markets. Everything gets sold, and correlations increase in down markets. And part of that is for a reason. If you think again about the consumer staples that I was just talking about, which are like a safety trade, a defensive trade, because what do people always say about Procter and Gamble? Well, no matter how bad the economy comes, everyone still needs to go out and buy their toilet paper, so you can buy Procter and Gamble and have some degree of safety there. That's true until the bear market gets so bad that people are getting margin calls in certain sectors of the market and then being forced to sell Procter & Gamble, even though they don't necessarily want to, even though it's a safety trade, just because they need to raise cash. And that's how correlations actually do increase on the way down in bear markets. And a great conversation to have when you see a market that's down 20, 30, 40% is, hey, I've really wanted to own XYZ company for a long time. I think that they're a great company. It's just always been a little bit expensive, and I didn't want to pay up, and I didn't want to buy it. And now, well, get out your shopping list, because here is the time. Everything's on sale. Everything's trading for a discounted price. What are those really good companies that you might want to own for 5, 10, 25 years that you can just have sitting in your portfolio? Now is the chance to get them. Well, the interesting thing about this market right now is the S&P is a hair away from all-time highs. And I was just having a conversation with my traders at the end of last week about software companies saying, does anybody have a shopping list? We're in a deep bear market here in software companies. Surely some of these companies, if you do some real research, they have a moat. They have a business that's not as disruptible from AI as some others, yet they're selling everything down. Correlations were very high within the software sector itself. Everything got sold down. So at a certain point, it's like, well, which of these companies are the really good companies that you think will not be disrupted by AI, or potentially can even adopt some degree of AI and thrive? So that was really the question at a certain point last week, because without a doubt, some of them are going to be disrupted. Some of them are selling down because they should be selling down. But others of them, it's not that way. I mean, I think that, like, when you think about how AI is going to impact, let's say, Salesforce, well, there's a good chance that it may lead to a little bit of a slowing of growth for a Salesforce. But I think that a software like Salesforce, if you are already working in a large company that uses Salesforce, it's going to be so disruptive to business to get rid of Salesforce and replace it with something else. So I don't think that companies that are currently using Salesforce are going to go, oh, I have ChatGPT now, so I can just throw Salesforce out the window, and the company that I manage of 5,000 employees, they're going to be just fine making that change. I don't think so. I don't think it's going to work that way. So I think that Salesforce has some degree of a moat around it where people are still going to be able to be involved in it. Maybe, some names in the cybersecurity space. Like I've been liking this SentinelOne, which has gotten beaten down a lot. ESTC is another one that's more data related name that I think is going to be just fine. So, that's really the question, is which one of these are companies that I can be involved in here, and I'm getting a steal of a price because they're selling down everything that's related to software, and which other ones, should I be staying away from?
All right. So when it comes to the rest of February, as you mentioned, typically a pretty seasonally weak month for the market. What are you looking at in this market, Derrick? Anything you like? Anything you're expecting? Any surprises you're looking for in February?
So last week was a very, very active week with the mean rotation trade. And now that trade has worked over the course of the last couple of days, I came in and I was doing my research this morning, and I was like, wow, I don't have anything new that I like right now at all on either side. My expectation for this week in particular is that it's going to be a little bit more of a difficult and choppy week. And then again, that seasonal peak in the market is typically around February 13th. We'll see as we get through February OPEX if any support levels begin to break, if correlations begin to increase, what the systematic buyers or sellers in the market are potentially doing. So what I told the team in the morning meeting this morning is sometimes less is more in trading. Sometimes preserving ammo is the smartest thing that you can do in the market. So for me right now, for this week in particular, I still have some good trades on from last week that we discussed that I'm managing out of right now because they're all working for me. Open to some day trades. Took a few day trades in a few names today. I've been doing that every day. But for the most part this week, I'm actually taking a little bit of a half step back, and I'm waiting for the market to give me more information. And I feel very uncertain right now because I'm looking at a NASDAQ that's giving me one message. I'm looking at an equal weighted S&P that's giving me a completely different message. So if the market is giving me competing messages, that is my cue to say, all right, it's time to take a half step back, be a little bit patient, and wait for the messages to realign, because that is when I'm going to be at the greatest advantage in terms of putting on new risk and going after more P&L. So I am honestly, I had my most relaxed trading session today so far. I'm up an okay amount of money. It's been a very relaxed trading session, and it's felt great actually compared to where I was last week, where it's like hectically being at my computer until 8 p.m. Eastern on Thursday because the market was capitulating at 7 p.m. and then needing to be logged back in at 4 a.m. Eastern the next day, which is 2 a.m. local where I am, because everything was moving so big overnight that all that stuff that if you just bought on Thursday late night was actually up huge by Friday early morning. And, that just wasn't very good for my sleep cycles. And now it's great just to be a little bit more relaxed this week and say, hey, the best thing I can do is just wait for this market to give me a clearer message.
All right. A relaxed week. No complaints about that. Hopefully it'll stay that way, but there's a lot of catalysts coming later this week. So maybe you'll get a little bit of action. All right. Derrick is a real trader. Again, he is the head trader at T3 Trading Group. So if you'd like to work with him and the team there, you can go to t3live.com/DOLive and fill out that form there, and someone from the team will get in contact with you. Again, that's t3live.com/DOLive. Derrick, thanks so much for your time today. Have a great rest of your Monday. I hope you have a great week. And next week is a holiday, so we will not be here. So we'll talk again in 2 weeks, and we'll see how February is going so far toward the end of the month. So have a good one.
Thanks, Retta. Talk to you next time.
All right.